The following presentation is an analysis of Coca-Cola's cash flow statement to evaluate the sources and uses of cash. Along with a comparison of the strengths and weaknesses of the company, the cash flow statement shows how a company can generate and uses cash. It is divided into operating, investing, and financing activities. There are differences between the net income and the cash flow from operating activities. The major sources of cash for the operations section shows a consolidated income, a net income of $9,571 million. The depreciation and amortization came to $1,260 million. That's per Coca-Cola in 2023. On the other hand, the financing cash flows major sources were $3,972 million from debt issuances and $837 million from issuings of stocks per Coca-Cola in 2023. Finally, the investing section cash flows major sources were $4,771 million from the disposal of investments and $558 million in proceeds from the disposal of businesses. Equity method investments and non-marketable securities, and that's per Coca-Cola in 2023. The operating activities, major cash outflows were the net change in operating assets and liabilities of $685 million. The equity or loss net of dividends was $836 million. The investing activities, major cash outflows, were investments that came to $3,751 million per Coca-Cola. Those investment purchases included property, plants, and equipment that totaled $4,930 million. The financing activities included paying of debts of $4,930 million and $7,616 million from purchases of treasury stocks per Coca-Cola in 2023. They all decreased the company's cash flow regardless of their nature. The differences between net income and operating cash flows. The operating cash flow has been generated from the operations of the company in a given period. The net income is determined after the following have been deducted: the expenses, goods, and merchandise sold, along with taxes from the sales of revenue. The net cash from the operating activities came in to $11,018 million, which gave a net income of $9,571 million, according to Coca-Cola in 2023. According to Bragg in 2024, the operating cash flow net is more than the net income due to the adjustments made. The non-cash items like depreciation are added back, which among other items leads to an increase in operating cash flows. The operating cash flows also reflect the cash transactions that have occurred during a certain period, while the net income recognizes some activities where cash was not or has not been paid, as they represent the costs which go into generating the revenue. Financial strengths of the company. So generating positive and high consolidated net income signifies that the company is profitable. Additionally, the company is strong because it can easily raise debt from the market thanks to its ability to generate positive operating cash flows. Consequently, the company's ability to generate a positive cash balance also signifies its strength. This is a representation of the company's longevity. Their financial weaknesses, however, this company has not managed to obtain an increase in the net income, which is $9,571 million, whereas in 2021, the consolidated net income was $9,804 million. The current cash balance is $9,519 million, which is lower than in 2021's cash balance of $9,684 million. The operating cash flows of the current year are $11,018 million, which was lower than the previous year at $12,625 million. In conclusion, it seems that Coca-Cola has several strengths and weaknesses in terms of its cash flow and financial position. The strengths are that they have a positive net income. The fact that Coca-Cola generates positive net income indicates that the company is profitable and has the ability to generate earnings. 2, the cash flow from operating activities. So the cash flow from operating activities is a major source of cash for the company, which suggests that its core operations are generating positive cash flows. High cash balance. So Coca-Cola's high cash balance indicates that the company has significant liquidity and can meet its short-term obligations. Their weaknesses. They have an inability to generate a higher cash flow from operating activities. If Coca-Cola is unable to increase its cash flow from operating activities, it may indicate challenges in improving the efficiency its core operations or managing working capital effectively. No significant increase in cash balance. If the cash balance does not increase significantly compared to the previous year, it may suggest limitations in generating additional cash or deploying excessive cash efficiently. No significant increase in net income. If Coca-Cola fails to achieve higher net income compared to the previous year, it may indicate challenges in growing profitably or managing their costs. If the company continues with these trends, a steady decline can be expected. However, the longevity of this company gives proof is here to stay, and its financial foundation will level out. These are the references used to conclude this presentation. Thank you so much.